Are you wondering how the sequence of returns in the market can affect your income for the rest of your life? Well, stick with us for the next few minutes and we'll tell you all about one of the most common things that people forget to plan for when thinking about their retirement. Hi, my name's Jared Carlin and I'm the Vice President of Carlin Financial Group.
And I'm Matt Carlin, founder of Carlin Financial Group. If you have questions about your retirement, subscribe to our channel and click on the bell and we'll notify you each time that we post a new video.
So, what are a sequence of returns in the market? Well, we all know that the market can go up and the market can go down. We all want the market to go up, but sometimes that's not exactly the way things go. So when we refer to the sequence of returns, we're talking about the order in which those ups and downs happen and how they can affect you and your plans for retirement.
So let's think about historical returns of the stock market. Well, over the last 90 years, the S&P 500, which is probably the most common gauge of how we keep track of the stock market, has averaged just under 10%. A lot of people will tell you, invest in the market, stay in the market. You could average 10 to 12% returns. And there are times when that is probably true. But unfortunately, there are times when that is probably not true. And depending upon when you retire, that could have a big effect on you.
Let's take a look at how the sequence of returns can pose a risk to your particular portfolio returns over a given period. Now, we've talked about how the return in the market and over history has been, 10 to 11% maybe. But what if we look at just a period of time? Because remember, retirement only happens once. You only get that one chance, those 20, 30, maybe 40 years to enjoy, but it only happens one time. So let's look at the period from 2000 to 2018. Now, the first 10 years of the 2000s we refer to as the lost decade. You can see in this chart that we say that because there were a lot of down years. Just to get started in the 2000s, we had a series of negative returns in a row. That particular sequence of returns could have been incredibly damaging to your portfolio and taken a long time to recover. As a matter of fact, if we take a look at the entire period from 2000 all the way to 2018, the overall return of the market, including all of those dips and the needs to recover, averaged only 4.86%, less than half of what you've been told you can expect to earn in the market all the time. Now let's take a closer look at how the sequence of returns can pose a risk to your retirement. For that, we'll take a look at two brothers, Steve and Bill. Steve and Bill had both saved about the same amount for retirement, and they each needed to withdraw $30,000 a year from their retirement savings. The difference, Steve retired in 1990. Well, if you can remember, the 90s were a great time for the market, and having retired in 1990, Steve didn't experience a whole lot of down years, and so as you can see, his account balance grew quite significantly, and at the end of the period from 1990 to 1999, Steve was left with a little over $1.2 million in his retirement accounts.
Even though he was pulling out $30,000 a year.
Right. Now, if we take a look at Bill, Steve's brother, he saved pretty much the exact same amount to begin his retirement, and the only difference, he still needed $30,000 a year. The only thing different was Bill retired in 2000. Well, unfortunately for Bill, that timing was not nearly as great as when Steve was able to retire. For as you can see, Bill had to suffer through that lost decade. Multiple years of negative market returns while at the same time drawing out the income he needed to survive left Bill in a much more vulnerable position at the end of the 9-year period with only $156,000 remaining in his account. Now, if I asked you if you'd rather be Steve or Bill, I'm sure you'd probably tell me you want to be Steve. And the thing to remember is the only difference between the two is when they happen to retire. So, unless you happen to be equipped with a crystal ball that has a really good track record, you may want to plan for the unexpected.
None of us expected what happened in 2008. None of us expected to be stuck in our homes for 3 months around the beginning of this year. But it happened. It happened. And times like that can put a strain on you and your family and your retirement. If you're concerned about how the impact of the sequences of returns can affect your retirement, click on the link below and apply to become a client.
And if you like this video, give it a thumbs up, share it with your friends and family, and be sure to subscribe to our channel so we can let you know when we release new videos. Thanks for watching, and remember, live today, plan for tomorrow.